Accounting for a merchandising business. In this section we will look at the big ideas of using a perpetual or periodic inventory system, how to account for purchases and sales under each system, and the concepts of gross margin and how this is important to a merchandising business. The concept of gross profit is very important to a merchandising enterprise. In order to calculate gross profit, you would take the value of the sales of goods in inventory less the value of the inventory at the price you bought it. Or cost of goods sold. Sales minus cost of goods sold equals gross profit. Ordinary expenses known as operating expenses. Things like rent expense and insurance expense are deducted from gross profit to get net income. Gross profit represents the amount of money you are making by selling your inventory, so it is an important measure for the merchandising business. A perpetual inventory system. Modern businesses use a perpetual inventory system to calculate the cost of goods sold for each sale as it is made. It also updates inventory on hand. This is very important to merchandising businesses as it can now track the amount of inventory available and calculate the actual cost of goods sold for each sales transaction. Using a perpetual system, you must record both sales and purchase transactions as they occur. When inventory items are purchased, your entry would be debit merchandise inventory and a credit to accounts payable. Purchases are only recorded when you have actual title or ownership of the inventory. Whether you own a shipment of inventory depends mainly upon an agreement with the supplier when the goods are sold. Every invoice will have the terms of the agreement to be FOB shipping point or FOB destination. FOB shipping point means you accept ownership of the inventory at the supplier's trucking dock and you will pay for the shipping costs yourself. FOB destination means you accept ownership when the truck arrives at your shipping dock, and the shipping costs are paid by the supplier. This slide illustrates the accounting difference between the two methods. Note for each method when ownership of the inventory changes hands. Why would this be very important to a merchandising business? Merchandising businesses must also account for purchase returns. When a business buys inventory, some of that inventory will be defective or broken. These goods are usually returned. Or the supplier will give you an allowance. This means you will keep the goods but receive a reduced rate. Merchandising businesses will also receive quantity discounts and purchase or financing discounts. These will be recorded as a debit to accounts payable and a credit to merchandise inventory. This entry reduces both your inventory value and the amount you owe your supplier. Notice that a purchase discount is a reduction in price due to the early payment of an invoice. The amount of discount is usually shown on the invoice and is stated commonly as 2% in 10 days. Or if you pay after the 10 days, you must make full payment in 30 days or net 30. On the invoice received by the supplier, the payment terms will look like this. In common language this is stated as 210. Net 30. This means if you pay for your shipment within 10 days you will get a 2% discount. If you don't pay with 10 days, the full amount will be due in 30 days. Or net 30. Your customers will also return goods that they find defective. These are known as sales returns. You may accept the goods back and return them to your supplier. Or the supplier may give you a price reduction or allowance. Note that if you return the merchandise, two accounting entries are required. One to reduce sales, and the other to increase inventory for the amount returned. A merchandising business will also give sales discounts for quantity, and for the early payment of an invoice. These discounts are usually recorded in separate accounts known as contra-sales accounts, so a business can track how much is being returned. All of these inventory transactions are shown using a multi-step income statement. Note that sales shows the amounts of sales discounts given over the income period, and the cost of goods sold shows the amounts of purchase discounts granted to give the company gross profit for the period. On the balance sheet, merchandise inventory is a current asset shown at the cost that you paid for the goods. The other method of accounting for inventory is called a periodic inventory system. The periodic inventory relies on a physical inventory count, done at the end of the physical period. Under the periodic inventory system, cost of goods sold can only be determined if a physical count of inventory is taken. Purchases of inventory under the periodic system are recorded differently. A separate purchases account is created and used in the cost of goods sold calculation. The amount of inventory on the balance sheet does not change until the physical inventory is taken at the end of the year. Sales revenue is recorded the same way as a perpetual system. And all sales discounts, sales returns, and freight costs are recognized the same way as a perpetual system. When using the periodic inventory system, you must manually calculate cost of goods sold. The calculation is stated as opening inventory plus purchases minus your closing inventory. This cost of goods sold is compared to sales to get the gross profit for the period. Finally, there are two important financial ratios used by merchandising businesses. Both are measures of how profitable your selling of inventory is for the business. Gross profit margin. Gross profit is divided by net sales to get the gross profit margin percentage. The higher this percentage is, the more profitable your company is selling their inventory. The other measure is the profit margin. This is calculated as net income divided by net sales, and generally is a very good indicator of the overall return a business is getting. The higher your profit margin, the better your business is considered doing. That's it. Perpetual versus periodic inventory systems, sales and purchase discounts, freight costs and the concept of gross margin are the important big ideas in this section. Ladies, the line forms on the left.